What is ASC 606 and its impact on SaaS profit and loss? Imagine trying to track your earnings accurately when your income comes in small pieces over time. That's what ASC 606 aims to do for companies. It's an accounting rule that changes how revenue is recorded. Developed by the Financial Accounting Standards Board and the International Accounting Standards Board, it creates a clear way to recognize revenue from customer contracts. The goal is to make financial reports more comparable and transparent across industries. The core idea is a 5-step process. First, a company must identify the contract with the customer. Next, they find out what specific promises or performance obligations are in that contract. Then, they determine the total transaction price, which is the amount they expect to earn. After that, they allocate that price to each obligation based on its value. Finally, revenue is recognized when each obligation is fulfilled. For software-as-a-service companies, which usually operate on subscriptions, this rule has a big effect. Instead of recording all the revenue when the customer pays upfront, revenue must be spread out over the period the service is delivered. For example, if a customer pays 1 year in advance, the company can only recognize 1/12 of that amount each month. The rest is recorded as deferred revenue, a liability on the balance sheet, until it is earned. This change affects how profit and loss statements look. Revenue appears more evenly over time, which can make early periods seem less profitable. It also means that cash received before service delivery is not counted as revenue immediately. Instead, it's recorded as deferred revenue until the service is provided. This method aligns revenue with the actual delivery of services, making financial reports more accurate. For SaaS companies, this means tracking multiple performance obligations. They might include access to the software, customer support, and onboarding services. Each of these needs to be accounted for separately, and revenue is recognized as each part is completed. This can require more detailed systems and processes to track obligations and recognize revenue correctly. From a financial management perspective, following ASC 606 means companies need good software tools. These tools help handle complex contracts, allocate revenue properly, and keep accurate records. Proper compliance ensures the company's financial reports are clear and meet regulatory standards. It also helps investors and stakeholders see a true picture of the company's performance over time. In summary, ASC 606 changes the game for SaaS companies. It shifts revenue recognition from upfront payments to a more realistic, service-based timeline. This affects profit and loss statements, requiring better systems and practices to stay compliant. It's all about matching revenue with the actual delivery of services, giving a clearer view of financial health.